As the stock market wobbles, it's a good reminder that the long run isn't always your friend, is it, Pablo? Pablo's your friend. You got a friend in Pablo. My man Mark Hulbert had written this in Market Watch, and I like Mark. This is just not a great article. This has got a lot of weak sauce. We'll go into this, and I've been following Mark Hulbert for a long, long time. So this is not a ding on him. I was just kind of surprised that, and he addresses some of my issues, but just kind of after the fact. Anyway, as a point of reference, I suppose I've never been a believer that stocks are the long run thing. And look, I got Jeremy Siegel's books up there. I'm a big fan, long time, first time, but the long run never arrives. It's kind of like Keynes says, John Maynard Keynes. In the long run, we're all dead. The long run is always in the future. It's kind of like if you're a heroin addict, you're always chasing the dragon. You never catch him. You never catch the dragon. We never catch the long run, man. It's always way out there. All we care about today is the next year to two. That's it. That's what investors care about. Now you can say, well, the stocks get less risky the longer you hold them. Well, not necessarily, because the facts are if you're pulling money out of stocks at it doesn't really matter what pays. It matters what the markets do. You might be exhausted of money before the markets are before the long run arrives, because it never does. All people care about is right now. They don't care what it is 15 years ago. They just care right now. They say, yeah, in 15 years, yes, maybe, but we don't know the future. This is what drives me crazy about this. The stocks for the long run. Just hold on. You always make money. You never lose money. We don't know that. And the only thing that matters is what I'm doing right now. And if I'm pulling money out of the portfolio, what did they say? Was Buffett say? The markets can stay irrational longer than you can stay solvent. I'm not sure if that's Buffett or again Keynes. I don't know. The markets can be irrational longer than you can stay solvent. And I just never liked this idea that, well, if you just hang in there, you'll be fine. Not if you're pulling money out, man. All right, so let's read this real quick. But that's not even my issue with this article. I've just never liked that stocks in the long run as a way to just stay in, stay in. You're like, I mean, I get it. I don't want to market time, but this idea that the long run someday never comes. That's a CCR song. I'm here to tell you now, each and every mother's son, you better earn it fast. You better earn it young. Something like that, because someday it never comes. The long run never comes. All right. The stock market doesn't necessarily produce handsome returns over time. I did this on a live stream last night, but I want to do it here as well. All right. Here's a NASDAQ right here. We've got a little battery, so let's move to the other room, shall we? Here's the NASDAQ at the end of March 10th, 2000, right here at basically 5,100. Fast forward to right there when it finally breached the, this is adjusted for inflation, by the way. It finally got back above where it was adjusted for inflation. All right, finally right there. And then it fell below, and then right here where it actually stayed, we think permanently. We don't know. But there you go. So it took 20 years, 2 decades after its peak. The NASDAQ in inflation adjusted terms was still lower than where it had been at the top. Look at that, 2 decades. Isn't that nuts? This teaches a valuable investment lesson. The stock market doesn't always produce handsome returns even after many years. Since the top of the internet bubble, and right here, the NASDAQ has produced 1.8% inflation-adjusted rates of return. Wow. A 2-decade period in which stocks lose ground to inflation is a scary prospect for those whose retirement security is predicated on stocks doing better than that. This is one of the issues I take with Mark. To illustrate, imagine an investor in his 40s, 20 years prior to retirement, who follows standard financial planning advice and has a bulk of his portfolio invested in equities. What would it mean to him to retire if the portfolio at 65 is lower in real terms than it is currently? And the point being, the dude, or he says a chick, whatever, I don't care. The dude is 45 years old. What would it mean to him at age 65 if his portfolio were lower at 65 than what it was at 45, adjusted for inflation? Well, Mark, what is a guy who's 45 years old doing in his portfolio? I'm just curious. What's he doing? What do you think he's doing? Oh, he's adding to it. He might not be making much money, but he's adding to it, which is why you got to keep adding, by the way. Just keep plugging, keep plugging, keep plugging. Scary as that prospect is, it is even close to the worst stretch of stocks not being inflation. According to research from Ed McQuarrie over at Santa Clara University, who's a professor emeritus, and I followed Ed on occasion. I think he's a CPA as well, but some of the stuff he writes, I'm just not a big fan of, and this one is in particular, I'm not. So check this out. And Mark is quoting him. Look at this clown. Clown show right there. I do not like that guy. Did you know he's banning the largest opposition party? He's making it illegal. The largest opposition party in Ukraine. Sounds very much like Woodrow Wilson, doesn't it? All right. But I think even Woodrow Wilson allowed the Republican Party to exist. He just didn't want anyone speaking out against the war. Crazy. All right, so according to Edward Quarry, the S&P 500 in real terms was no higher in 1984 than it was in 1909. That's a 75-year period in which the benchmark posted a negative real return. Yeah, and this is where I say that, I don't know, man, that doesn't make sense. I've never heard this before. So Ed McQuarrie says, according to, after inflation, the S&P 500 is lower in 1984 than it was in 1909. Well, we're missing, doesn't that look like, I mean, what? That's just freaking creepy, man. This guy is, this whole thing is like a social media war. It's nuts. All right. To be sure, this 75-year period of staying even with inflation is focusing only on the price version of the S&P 500. It does not take dividends into account. But even when including dividends, it still is the case that the stock market periodically endures extremely long periods of just keeping pace with inflation. Really? All right, so we're not including dividends. Okay, let's take a gander here. What is the benefit of including dividends? Go to political calculations, the S&P 500 at your fingertips, and this is going on 15, 16 years old now, and I love it. And we're going to go to 1909 to 1984. 1909, I think is what he said. We'll start at 1909, and then we're going to end in 1984. All right, and we're going to show you here 1984 Krakow right there, and then we're going to calculate on the S&P 500. So the index price was 906 in 1909. It was 166 in 1904. So we scroll down and we say index rate of return without dividend investments was basically less than 1%, 0.64, basically just kept up with inflation. However, if you reinvest dividends, you get a 5.72% rate of return, net of inflation. 5.72 net of inflation if you reinvest dividends. Quite a big difference there. That's 500 times higher, 5 times or 500%, whatever you want to say, higher rate of return just from dividends being reinvested. So for Ed not to use that, you're completely missing the boat. To be sure, the 75-year period of staying even with inflation is focusing only on the price-only version, which is one of the reasons I don't like, by the way, index annuities, because they take out dividends. And dividends are such an integral part of your rate of return. About 40% of your return historically has been come from dividends. And we just showed you right there, from that time frame period of the S&P 500, basically 90% of your return solely is from reinvesting dividends. If you're not reinvesting dividends, you're wrong. If you're not using dividends like an index annuity does in terms of your performance, you're wrong. That's all there is to it. You got to use dividends. All right. Another statistic that really drives home the point of long periods of return of mediocre performance, out of the 229 calendar years since 1793, 44% has occurred in one of these 6 doldrums identified by McQuarrie. Well, I already discount McQuarrie because you're not reinvesting dividends, and your doldrum thing is silly. You got it. Most investors are in denial about this part of U.S. market history. Does Mark Holbert know that? I mean, does he know that most investors, am I in denial of it then, Mark? The extraordinary bull market of the past decade has spoiled investors into thinking that spectacular gains are to be expected. Yet, assuming the future is even remotely like the past, sooner or later they're in for a great awakening. It's a weak article. You don't know most investors like that. In fact, I would argue it's the exact opposite. I think most investors are scared for the future because we had such a good rate of return in the past, I'm not sure I can get those same. But anyway, using Edward McQuarrie's, he did something on Social Security and taxes that kind of ticked me off too. And I'm not against the guy, just like, I was surprised by that. I forgot what it was. I did a video on it 3 years ago. Point being is, all right, you got no rate of return if you're only using price. But who does that? You want total returns. Total returns, man. Mark Holbert knows this. And I don't understand why. I don't get it. So, let's just see. I put a comment on there last night. Let's see if it's stuck. All right, Stephen Scott. The S&P is created night. Okay, hold on a second. Let's keep going. Oh, wait, my comment on here. Where do you find comments? Comments. No comments. That's it. All right. I put a comment on there yesterday. I'm not sure what that's about. Yeah, that's weird, man. Served by newest. All right. Yeah, they didn't put my comment on there. That's interesting. All right. The S&P 500 was created in 1957 and decided what financial would require a lot of Okay, what I just don't care. Anyway, the point being is, if you're not reinvesting dividends, we can make anything look scary. But life's too short to drink cheap wine. Just reinvest your dividends. All right, we'll see you guys. Love to hear your thoughts.